The date is May 7th. It is Wednesday evening, 8:30 p.m. Eastern. This will be a Watchhimtrade.com webinar going over questions submitted by subscribers. So the first question I received was, how do you manage a trade? How do you manage your exit of a trade when it fails and starts to go against you? So how do you deal with a loser? How do you take a loser? Great question. And I'll have some examples here to go over everything. That's why we're looking at a video screen right now. But first of all, this really starts down with your preparation and then your execution. The best way to manage a losing trade is to avoid entering one in the first place. So don't settle. Don't let the market force your hand. Have an entry that you want and is ideally near your stated stop loss. Your trades need to be premeditated. You can't just react and jump in. You need to have envisioned the trade before you make it and have an expectation for what you expect to happen. Where if action is catching you off guard, it means you weren't properly prepared, and if you then enter a trade off of that, more times than not, bad things will happen. Now, obviously, you can't always avoid that losing trade. So let's deal with this question, assuming you've done everything right preparation-wise and execution-wise, but it's just that the trade didn't work out. You got the price you wanted, you're near your stop loss, but you're just wrong about the direction you thought the stock was going to go. You're simply wrong, and now you have a loser, and you've got to deal with it, and you have to manage it, and you want to keep it small and get out. So the first thing you need to do is you need to be defensive, okay, in managing that loss. As soon as I enter a trade, I always get a limit order ready about 10% below my entry price. So then if the price starts dropping and then I see that price I entered start to be the best bid, I know I'm approaching my 10% loss threshold area, which I really can't go too much over if I'm being smart. So that's the first step, is to be defensive. I believe it's much easier to switch from defense to offense. It's much easier to switch from defense to offense than it is to switch from offense to defense. It's easier to switch from defense to offense than it is to switch from offense to defense. And I think that point is proven true by the fact that most of us have no problem taking winners, but we often struggle to take losers. And this point is further illustrated that when you consider, on average, a trader will sell a winner that was previously a loser quicker than they will sell a loser that was previously a winner. On average, a trader will sell a winner that was previously a loser quicker than they'll sell a loser that was previously a winner, because they're waiting for that loser to go back to a winner. They're waiting for it to come back. So step one, be defensive. Step two, take notes in a notebook next to you as your stop loss is being tested. This will help you avoid paralysis or deer in the headlights syndrome, whatever you want to call it, by writing things down as your stop loss is being tested, such as need a reject right here, or testing stop loss, really need a move back lower, need a move back higher, need a bounce, need this level to hold. Writing that type of stuff down and seeing it on a sheet of paper next to you, that will help train your mind to understand that this really is the area where you need to exit your trade if it doesn't start working for you. It's a way to reinforce the responsibility you have to yourself in the trade. If you don't take notes as you are reaching your loss threshold, you are in essence failing to remind yourself that you are responsible and you're to be held accountable for the trade. Taking notes is a great way to remind yourself that you are in charge and reinforces that and helps keep you in charge. So step 2, take notes. Step 3 in managing that loss is the actual acceptance of the loss. Okay? Taking it, moving on. And this is all about psychology. Most people view losses as a disappointment and a discouragement. You cannot view losses that way. You need to view losses as empowering. Okay? They need to empower you. I was strong enough to take a loss, and I didn't give a fuck about taking it. All right? Not, God, I don't want to take this loss, man. I'm so fucking pissed. Sick of having a loss, man. I was up 5 trades in a row. Now I'm going to ruin my streak. No. You need to empower yourself. If you are taking the notes and the percentage loss is persisting, you know the right thing to do is to take a loss. On average, most traders know when they are in a losing trade, but their psychology tricks them into thinking that the losses should be a punishment for making the wrong decision. Telling you right now, there is no reason to punish yourself. Don't view losses as a punishment. View them as a reward. Just like making a good percentage gain is rewarding, making small percentage losses should be rewarding as well. How rewarding is it when you sell at a 10% loss and then you see that same position drop an additional 50% loss? If you're anything like me, it's extremely rewarding. So you need to remember that feeling of reward and avoid talking yourself into staying in. Empower yourself. So the 3 steps we have to managing a loss. Number 1, be defensive. Number 2, take notes. Number 3, be accepting and empowering. Okay? Now there's a couple things that you must avoid that, if you're struggling to manage the loss, at the very least avoid these things because they'll at least keep things from going from bad to worse. Number 1, changing your stop loss. Do not change your stop loss. You chose your first stop loss for a reason. Don't talk yourself into changing it. 9 times out of 10, it is not the right decision. Number 2, averaging down. Averaging down is when you bought what you intended to be your full position. Now you're at a loss that you haven't yet taken, and you buy more. Note that this is completely different than scaling in. Scaling in is when, in preparing for the position you're about to take, you say, I'm going to buy $1,000 worth, but you've only bought $250 worth so far when you're at the loss. It was a part of your plan to scale in $750 more over a couple more buys. So you're scaling in. That is not the same thing as averaging down. Averaging down wasn't a part of the plan. Scaling in was a part of the plan. Talked about being premeditated with your execution. Again, this is why prep is so important. Number 3, prolonged hold times. Have a time frame for which you expected the trade to do what you thought it was going to do. If you bought in looking for a move in the next 10, 15 minutes or so, and you're still holding 60 minutes later, then something isn't right in your analysis. So just to recap, and we're going to have examples of these now. Number 1, once you enter the trade, your first step is to be defensive. Number 2, take notes as your stop loss is being tested. Don't get paralysis. Number 3, accept the loss and view it as empowering. 3 things to avoid: averaging down, changing your stop loss, and prolonged hold times. So what you're going to see in this first clip is an example of me being defensive as soon as I enter a trade. Okay, What I want you to notice is that as soon as I enter this trade, you're watching Netflix from April 23rd. You see the level 2, it comes up to 367s. You're going to see on the level 2 here, I'm playing the 357.50 put. You're going to see I put my limit order in at 240 to fill a bid. You're going to see my position pop up right here. So here's my bid. All right. I'm about to get filled on my bid. And then as soon as my bid fills, you're going to see that the spread opens up and I lower my limit order to $2.04 as the stock is testing 366, 367, which is an area that I said I wanted to short Netflix at on that day. So this started with my prep. I was looking to short 366 to 367s. I got the entry point I wanted, and now you can see I've lowered my limit to $2.04. So I'm being defensive. I'm being defensive in my head. As soon as I enter the position, I know, hey, if this doesn't continue to work, I've got my limit, I'm queued up, ready to sell, ready to exit. So now it's just a matter of I'm watching level 2. Long as everything is staying okay, long as I'm continuing to get stalls on 367, I can stay with the trade. Fast forward a few seconds, and again, being defensive, I have an order queued up, ready to sell if it's not going to be stalling on 367s. I've got this order ready to sell at $2.10 for a slight loss. So still being defensive. I'm thinking defense first. Now I'm starting to get 365s. Now my position is going in the green. So now I'm starting to think, okay, now I'm starting to think I'm on offense. The bids are stacking above my break-even price. Netflix is starting to lose 365. And once that happens, I want to start thinking about upside targets. And you fast forward a little bit more, you can then see 320 by 365. I end up selling this position at $3.70 as Netflix, you can see, has moved from 367s down to 362s. All right, so enter the trade where I wanted to enter the trade. Started with the prep, then the execution. Then once I did that, I got defensive. And then once it started moving into the 362s, I wasn't worried about defense as much. I no longer have that sell order queued up, and I'm getting ready to play offense. That is a good trade. That's how I want to execute. It's not a losing trade, right? But if it was going to be a losing trade, I was ready. I was ready to get out. And ended up making 54% on that particular trade. All right, so now let's look at the next example. This will be a losing trade, but same thing. I get defensive. Okay, so in this case, Netflix is going to be testing 326s. I'm looking for a move back down below 325, so I'm shorting 326s with the thinking that if it starts holding 326s and pushing 327s, then I need to stop myself out. Otherwise, if it goes below 325, I'm going to have a, solid gain. So again, you'll see my position pop up here. I put a bid in at $1.40 any second now. All right, so there's my bid that's about to go in. My order fills. And now watch what I do as soon as I enter. As soon as my order fills, just a few seconds later, As it's testing 326s, I get defensive and I downtick the limit in case I have to stop out. So I'm downticking to $1.20, which is between 10 and 15% loss, and I'm defensive. I'm ready to stop out if Netflix starts pushing 327s, because I know that I'm looking for a 325 breakdown. So if you start getting 327s, I'm wrong about the trade, and I need to minimize my loss. You're getting 327 prints here. My limit order is already in at $1.20. You start moving through 320s. I get my finger on that trigger, ready to hit the sell button. Give it one last second. You're getting 327s, 328s. Boom, I'm out, 14% loss. Maybe it was the bad trade to have placed in the first place. Maybe it was the right trade. Whatever. It doesn't matter. The key is I managed the loss properly. I got out with a 14% loss. Kept the loss small. So now what we're going to look at, we've seen an example of being defensive turning into a winner, never having a loss, being defensive and managing the loss properly. Now we're going to see bad management on my part. This was from May 5th. The last video was from May 1st. You're going to see that I enter a trade here on Google. Notice where Google is. Okay, Google is around 528. All right, so kind of no man's land. My reference point on that day was 530 or 525 or 535. But watch me. So you print in 527s, and here I go. I enter puts. I'm entering puts at a awful entry point. All right, there's no reference point set up here. There's just nothing here. I'm not close to anything. So here I am. I'm in at 275, and I am in complete no man's land. I'm not close to a 525 breakdown like I was, potentially with that Netflix 325 breakdown in the example I just showed. I'm not backtesting 530 for a reference point backtest. All right, so the trade starts off on the wrong foot because of a poor entry. So then if we jump forward here, you'll see I do something even stupider. So notice I've still got my one contract. All right, position size 1. Google is still in the 528s. But then let's take a look at the good idea that I had here. All right. So watching price action, Google's still in the 528s, not showing any signs of doing anything. And take a look at me. I decide let's buy another position, even though I'm already at a loss and the spread is already against me. So now I've got a 2-contract position instead of a 1-contract position. Average down for seemingly no reason. So I am breaking the rules here. So let's fast forward. This is about 20 minutes later. Notice Google is now backtesting 530. And you look, I am still in my position. So I average down number 1. I'm not getting out as it's continuing to come back to 530. And number three, we're talking 20, 25 minutes later, and I'm still in the trade, a prolonged hold time. All the while, I'm still sitting in here. I finally capitulate and exit with a bad, I think, 30% loss or so. And it's just not good execution. It wasn't good execution from the start. A poor entry led to a poor trade setup all the way around. I've allowed myself to exceed a 20% loss without exiting, even as by that point Google kept coming back to 530. It's not getting rejected hard at 530, and I'm still just sitting in the position. And if you notice, what you'll see here is I start watching Apple. And this point is significant because on this day, Apple's making a solid move. So like right here. So right here, I've just transferred my window over to Apple because I know that, hey, Apple's making a really nice move here. But the problem is I'm stuck in a Google position that I shouldn't be in because maybe I should have never entered it, but once I did enter it, I didn't exit it when I should have, and now I'm distracted by it, and it's keeping me from playing a better opportunity in Apple stock. So I end up stopping myself out finally, which, at least I finally did. But now, instead of just focusing on Apple at the get-go, I'm digging myself out of this hole that I'm in because of Google, because of my poor execution. And I ended up making a pretty good trade on Apple after I exited that Google position. But again, I'm fighting from behind at that point instead of playing from ahead. So 3 examples. The first one was a good trade, exactly how I want to navigate. The second one, I lost money, but I still call it a good executed trade because I stopped out quickly, kept that loss small. And then the third one is exhibit A of what you do not want to do from entry point to exit and everything in between, all the way around. Bad execution. And hopefully with those examples, you have an understanding of how you should manage a trade that starts to go against you. And, what you should have gotten out of that is the management of it starts before it ever starts to go against you. Okay, next question. Is relative to futures. This person asks, why am I looking at futures before the market opens? Are they a good way to gauge market direction and sentiment? Also, what should I look at or for? Which futures should I watch pre-market? Well, futures dictate what the S&P 500 is going to trade at, and they are definitely a good gauge of market direction and sentiment. Remember, futures are actual contracts that are bought and sold, guaranteeing delivery of said contract at a certain price by a certain date, similar to options. So when you see S&P futures going for 1873, such as they are doing right now, that in essence is somebody saying they want to own the S&P at 1873 at the current expiration, which is June 2014. And the future that you should watch is always the nearest strike because they are the most liquid. You can find that on the CMEgroup.com website. I just posted it into the chat room. Your broker should have a specific symbol for the S&P 500 E-mini futures, which are the most liquid ones and the ones that I track every day. And, they're usually different. Mine is ESM 14. I doubt that's your symbol, but your broker should have a symbol lookup box that will allow you to search for the proper futures symbol. And as far as what you should be looking for, it's really the same thing that we look for in the trades we try and make. We want to identify a trend, potential changes in that trend, support and resistance levels, reference points, and then speed of movement. Now with futures, it's neat because they give you insight into the S&P 500, so you can kind of get a feel for market direction, and it can be very useful for pinpointing reversals or breakdowns or breakouts or fake outs or fake downs. So let's go over a couple examples where futures were helpful to your market trading in general. So you look today, the futures had a nice flush. This is a 3-minute chart of the S&P 500 futures from today's date, Wednesday, May 7th. And you look here at this move I'm circling, you had a nice flush lower, and it was pretty quick though. Happened right around 10 o'clock or so. It was specifically from 10:10 to 10:20. All right, so you had this flush lower in the futures, right? Well, if you then look at some of our intraday charts on our primary stocks, so the futures moved lower from 10:10 to 10:20, right? You'll see a lot of similar moves happened in primary stocks. Look at Apple. Apple made a move lower then from 10:10 to 10:20 as well. Futures put in their lower day at 10:20. Apple put in its lower day at 10:20. You look at Google. Google today, here it is from 10:10 to 10:20 with a flush lower, put in its lower day at that time, same time as the futures. You look at Amazon, also nice flush from 10:10 to 10:20, put in its lower day at that time. So by tracking the futures and then tracking how your primary stocks are moving in relation to the movement in the futures, you can get a feel for if there is a unison trend going on between futures and the particular stocks you're tracking. So that's just an example from today. Futures bottom at 10:20, so did some of these primary stocks. And then looking back at futures again from today, you had this hammer bottom on a 3-minute chart. We know that a hammer bottom is sometimes a reversal. And then a nice move higher here, and then a little flag. And then when you tried to break lower, you couldn't do it. This inability to break lower between 11 and 12 o'clock was then followed by a nice rip higher in the futures, and then again an inability to break lower in the afternoon to new lows as well. And if you were to just look at the primary stocks that I just showed you, you'll see the same thing. Google tried to break lower to a new, this is Amazon, tried to break to a new lower day, failed to do so in the afternoon. Google managed to make a new lower day, but only slightly. It didn't sustain itself. It didn't build a continued downside pressure. Apple also tried to break to a new lower day, but was unable to. So some of the movement in the afternoon by these primary stocks wasn't confirmed by the movement in the futures. Now, you want to look for trends and an establishment of a trend or a reference point breaking down. You can see now we're looking at yesterday's price action in the S&P futures. You've got a lot of lows that were put in around 1868 to 1870 or so. Once you broke that low, though, just ahead of 2 o'clock, again, this is yesterday afternoon, it was between 1:30 and 2 o'clock that you broke that low and then experienced a nice little sell-off. All right, so right there in the afternoon, you see futures break down. So what I'm thinking at that point is, all right, futures just broke down, so a good chunk of my primary stocks should break down as well, if they haven't already. And what you'll notice, going back and looking at yesterday's price action from our primaries around that same time, you see Apple, right when futures broke down, Apple broke to a new low a day as well. You look at Amazon from yesterday, right when futures broke down, Amazon broke down as well. You look at Netflix yesterday. Now Netflix had already been downtrending, but once futures broke down, Netflix was then able to downtrend even further, going from 334s to 328s. So again, futures, selling off in the afternoon led to sell pressure in primary stocks. And, I'm just showing you these examples, but I would imagine if you picked a handful of stocks, you probably would see the same thing. So let's take one last look at where they can be useful. So that's intraday action. But let's look at pre-market action and how futures can be useful. So you're looking at Monday, this past Monday, May 5th in the futures. Notice we have this trend line here, which was right around 1866. It was getting tested in the middle of the night on Monday. And then around 9 o'clock, you had a breakdown below that support line, right? But notice off of that breakdown right here, you then immediately came back up. You had what I would deem a fake out, a V-type move, or where you go down but then you come right back up. I refer to that as a fake out. So at that time, once I see that, I'm thinking to myself, all right, it just faked out to the downside, so be on the lookout for fake outs today, based on what it showed ahead of the open. And lo and behold, look at what you have once the market opens, right around 9:30 ahead of 10 o'clock. You break down right here, just like you broke down ahead of the open, but it ends up being a fake out, and you make up all of the losses from that breakdown and end up having a nice directional move higher on the day. So having identified the action in the futures pre-market that there was a fake out to the downside, maybe doesn't get you caught shorting this move lower, because you're thinking maybe there's going to be another fake out to the downside. And if you, again, look at some of these primary stocks, going back to Monday, you'll see, looking at Google, and Netflix gapped down, opened below the around 340 level, right? But it ended up being a fake out. Gap down, but then a rally higher. You saw the same thing in Google. Opened below a round level, gap down beneath 530. Gap down, looked like it was breaking down. Nope, it's a fake out, ended up rallying higher. So the action in the futures pre-market gave hints that there might be moves like that would occur. And by being on your toes, because you knew how the futures were trading, you could have prevented getting caught in one of those tricky trading situations. So that is why futures are useful. They're especially useful when you're seeing new lows of days get made or new high of days get made. What are the futures doing? Are they moving in the same direction? Are they confirming the move? Are they not confirming the move? And that can be useful in helping you determine, hey, should I be getting out right here, or should I be sticking with the trade? Next question. Can you recommend some good trading strategies? I've seen your 3-minute candle video as well as your longer term strategy, buying when the highs and lows of the day are broken. Do I still recommend those, or do I have others? So I got to be honest, it's hard for me to recommend strategies these days, and even strategies like that I have done videos on in the past, because quite frankly it's just not what I do anymore. It's not what I use. So I'm not going to sell a product I'm not using myself. Those strategies, though, I definitely did use them in the past, and as far as I know, they're still effective, but I've really shifted from a chart trader, pattern trader, to more of a level 2 time and sales trader. I use charts to identify reference points, but I use level 2 and time and sales more than anything when I'm actually in the trade, and as far as determining if I should get in the trade, just to, what do I think of the price action. So I can't give you the answer you're looking for with the strategies, but what I will say is there's tons of technical strategies out there, and if some of them interest you, I'd recommend experimenting with them and seeing what your results are, and if you like using them. There's Fibonacci retracement strategies, moving average crossover strategies, MACD, RSI, stochastic indicators, chart pattern formations like head and shoulders and cup and handle, falling wedges, etc., all that type of stuff. So there's tons of them out there. I can't recommend them myself because I don't use them, but I'm aware of them. I'm strictly a day trader, so over the last year I've started to really stop feeling any major need to use any of those indicators I just mentioned for myself, as they seem to cater more to the swing or position type trader. If you're trying to day trade, I actually think over strategizing can be counterproductive because it distracts you from one simple method, and that is identify which way the tape is moving. And if it is moving fast enough, trade accordingly. If it's moving to the upside, trade to the upside. If it's moving to the downside, trade to the downside. So, in essence, I guess you could say that is the strategy I would recommend, is level 2 analysis and tape reading. And I've gone over a lot of level 2 stuff in a recent webinar that I just posted in the chat room. You want to start at the 31:35 mark in that video, and you'll see a lot of level 2 stuff. And honestly, if you just watch the archived footage that I have in the site just from everyday trading, you'll usually hear me talking about level 2 and time and sales more than anything these days. And what you might also want to do is go back in the archive and go back to last June, for instance, and you'll notice a major change, because I would think last June I'm probably using a lot more charting, and I'm probably talking a lot more about patterns that I'm seeing on charts, whereas today I'm talking a lot more about what I'm seeing on level 2 and time and sales. Lastly, what I do want to say, though, about the longer-term strategy you brought up, buying highs and lows when they're broken on a daily chart, is that was a strategy I came up with when I was trading penny stocks a lot, but I noticed it also worked on big boards. However, what I've noticed in 2014 it's been a very choppy market, and that strategy has actually produced a lot of false signals. So it isn't a strategy that I would recommend using in the current market environment. It's a strategy that needs to be used when the market is trending. Right now, the market is not trending. It's going up, down, choppy all around. So that I wouldn't think is a good strategy. Remember, with level 2 and time and sales, it's not going to click for you overnight. I've been doing this trading full-time now for 2.5 to 3 years, and trading to some extent for 5 years. I just now feel like I'm starting to get some expertise in level 2 and time and sales. So it's a process, and understand that and accept that. But that would be my strategy that I would recommend. So next question. This person says they need help with the timing of their entries as well as understanding how support and resistances are established. They feel like they're always kind of buying at the wrong time, and they think it's a part of the fact that they don't know if they're properly identifying support and resistance. So they've given me some trades to look over, and I will do that at the end. And then they ask for any other relevant advice on how to identify support and resistance, and just in general, I got the sense that this person wanted some insight into the particular stocks they were trading. So I will go over the trades you posted to me, but I've got some other things I want to bring up first. So someone asked me in a recent webinar, how do I know when to enter and exit a trade? Kind of the holy grail of trading. But I did my best to answer that person's question. And this is your answer is much less complex, and you give me some examples to go over for you, so I'll make it much, much easier. But I still definitely encourage you to watch that video. You can find, I just linked the webinar in the chat room. You can find the answer starting at the 20-minute and 25-second mark in that. Okay, and again, the question was, how do I know when to enter and exit a trade? So that's going to be a relevant answer for you. And then another video I have, which is only 8 minutes long, goes over how to identify reference points. This was a video I think I did last summer when I was really into using a 3-minute chart for a lot of my strategy trading. So that will show you, how I was identifying my supports and resistances using that 3-minute chart. So moving on a little bit though, figuring out when to enter and exit a trade and your timing and everything, that can be very tricky. But again, it starts with preparation. The market shouldn't open and then experience price action that you don't know how to react to. And if you watch the archived videos, I guarantee you, pre-market, you'll always hear me say, at least on one stock, this is exactly what I'm looking for to do X, Y, Z. I'm looking to go long if it's holding X price level, or I'm looking to get short right away if it's holding Y price level. So timing is obviously important, of course, but your timing is easier when you have already talked yourself through a trade scenario. So for instance, we're going to look at a clip from today's trading on Apple where it's testing 595, and pre-market, if you listen to it, and even once the market opens, I start talking about, hey, if Apple's holding 595, I want to enter a long trade because I think it'll give a little bounce. So you can see Apple printing 595s right here. Oh, wait, no you can't because I'm not showing you the right screen. Hold on. Let me go back. All right, so you'll see here Apple is testing 595s, and I'm looking at the 597.50 call. I have a buy order that I'm getting ready to place, but I want to see, is it holding 595 on the bid side? 595 area is kind of my stop loss. As long as you're not backing away from 595, I'm going to stick with this trade. So here's my buy order. I just place it. So there's my position. I'm in at $1.99. And then I believe I get defensive again right away, although this position actually started making money for me right away, so that was nice. But point being, I knew I wanted to go long if it was holding 595. That was premeditated, so as soon as I saw that price action there, I'm able to react to it, and I'm fortunate enough that the trade does work right away. And I'm just able to exit at 2:30, I believe, for a quick 16% gain to start the day. So I exit the position into some 596s. Bottom line, I already knew before the market opened what I wanted to do on Apple. So that made it much easier timing-wise. So now I want to address, support and resistance, because that's very important. I was able to trade Apple because I felt that 595 was a support level, or at least a reference area of some kind, that I could trade it with confidence and execute how I needed to execute relative to that price. And how do I know that 595 is the level? Well, this is why I trade the stocks I trade. High-priced stocks in the $100 range. I find it much easier to identify support and resistance on higher price stocks of that nature because you have more points in between 1% moves. All right, so like on Apple, every 5 points is just a nice psychological level. It's like, all right, $5, $5, $5, $5, $5. And from 600 to 595 isn't even 1%. So Apple can move 5 points from a round 595 reference point to a round 600 reference point, and it hasn't even moved 1%. All right, so I don't necessarily even have to look at a chart. I can just tell you, hey, if Apple's around 595, I'm going to focus on that level because it ends in a 5. I like it. If Apple's around 592, I can just focus on 590 because, it's close enough to 590. And on a percentage basis, I'm not getting away from myself in terms of the trade setup. Amazon, every $3 is 1%. So between 300 and 305, I'm only moving a little over 1.5%. If I'm down near 300, I can just focus on that. If I'm up near 305, I can focus on that. 295, I can focus on that. Hey, if you're 302, 303, I'm not going to try and trade that. Yeah, maybe it comes down 0.5% from 301.50 to 300. Now I'm near the 300 reference point. Yeah, I've missed a 0.5% move, but you know what? It could drop another 3 points, and that's still only 1.5%. So I'm still near. The trade is still intact, reference point wise and percentage wise. A big move hasn't been made. Netflix, same thing. Priceline is especially great because it's every 10, 11 points is 1%. Google, same thing. It's in the 500s. Now, I'm making this point because the same can't be said for a stock like Facebook. Facebook is in the 50s. So to me, the only round levels that are very meaningful in the $50 range is 50, 55, and 60. Yet those price points have 8% in between them. So this means you have to be much more precise and use more analysis within your chart reading to really have identified the important support or resistance levels. and it just makes life harder on yourself, in my opinion, when you're trying to prepare. And in addition to that, what you see is the strike prices are less trader friendly. So Facebook strike prices have 50 cents in between each of them. And this is my definition of trader friendly. I'll go over a different perspective in a moment. So Facebook has 57.50s, 57, 56.50s, 56s, etc. So in between the 57.50 strike and the 57 strike, you have nearly 0.9%. If you compare that with a stock like Apple, which has the 590 and 587.50 strikes, those strikes are only 0.4% away from each other. Netflix, the strikes are less than 0.8% away from each other. So is it easier for a stock to move 0.9%, like Facebook needs to do to move one strike to the next in the money? Or is it easier for a stock to move less than 0.5%, like Apple needs to do to move one strike from in the money to in the money, or out of the money to in the money? Obviously, it's easier for a stock to make a 0.5% move than it is for a full nearly 1% move that Facebook needs. So I'd rather play the option that will have an easier time going in the money strike to strike and needs less movement required by the stock. Now the trade-off is, of course, the cost per contract is higher priced on a stock like Netflix or Apple because they are higher priced stocks. So for instance, the in the money or the at the money Netflix put, so the 317.50 costs you $3.80. That's $380. And it's pricing a move down to what, 313s? Okay, or about a 1.2% move. Facebook, the at the money 57 strike put only costs you $68. So obviously it's cheaper to play Facebook on a cost basis in terms of your absolute cost. $66 is obviously less than $380. But Facebook, compared to Netflix on a premium basis, the stock pricing, those puts pricing in a move down to $56.30, that's still pricing in about a 1.2% move. It's pricing in the same type of move as the at-the-money Netflix put is also. So even though the Netflix at-the-money put is more expensive on an absolute cost basis, don't let it trick you into thinking that premium is more expensive. We care about the cost of the premium. At least I care about the cost of the premium. Maybe you're different. As opposed to, you know, the actual dollar amount. Because as long as I control my size, I can stomach paying $370 for one contract. Or if I have to, you know, maybe I'll go out of the money and further out of the money and play the 310s or 312.50s. What you'll find, though, is, you know, further out of the money on Netflix is still pricing in the same move as Facebook. They're very, very similar. Too many times we get confused into thinking certain options are cheaper because they don't cost as much on an absolute basis, when really they're not cheaper. They just don't cost as much on an absolute basis. So maybe some of your trading on your timing has to do more with the stock you're trading as opposed to, you know, your talent level and, you know, what your capabilities are. I myself used to try and trade Facebook a lot, and quite frankly, I sucked at it, so I stopped. As badly as I wanted to add Facebook to my repertoire, it just proved that it wasn't going to be a good decision for me. And especially, you know, as a subscriber to this service, I think you would find if you asked other subscribers that on a week-to-week basis, maybe there's a week here or there that kind of sucks trading-wise, but in general, the 6 stocks I'm following, at least one of them is going to give us something good, usually. You know, today it was Netflix and Amazon, Google as well. Last week, Apple was giving out the goods, so you know, it's just a matter of selection, and that can be important. Sometimes it's not about our talent, but it's about the situation we're putting ourselves in, and we actually get discouraged because we think we're doing something wrong when the only thing we're doing wrong is we're not selecting the right stock to play, and we're not giving ourselves a fair chance. So that's that portion of the answer. Now, you wanted some discussion on supports and resistances, and you sent me some of your own example charts here, which is great, because that way I can analyze them myself and get some insight into what you're doing. But let me, before I get to your examples and go over them, let me go over how I identify support and resistance myself. So first of all, I use a 3-minute chart to go over, you know, my day trading supports and resistances, because remember, you know, I'm focused on day trading. So yeah, you know, long-term trends and stuff, those come into play, but right here, right now, I'm more or less just focused on, hey, what happened today and what might it do tomorrow, right? So for instance, if you look at all my prep, let me get this pulled up here. So like coming into today, I always have my supports and resistances written down. Now, I type this up for you guys, and then what I do is I just print it out. So if you were standing over my shoulder looking at my desk right now, you would see 2 sheets of paper. The first one would have all of my over-under setups, and then the second one has my outlooks. So that's number one. You need to write down your supports and your resistances. It's not enough to me to just have them on the chart. You need to have them in front of you, because you're not always going to be looking at the chart. If you have a chart pulled up, that's taking space away from level 2 in time and sales, and you know that I think your best bet is to focus on level 2 in time and sales. All right. So let me get then to how I choose support and resistance. How am I picking the numbers I'm picking? What I think about is a cluster. You know, I want to identify areas that I feel like a decent amount of price action occurred, or the stock, you know, kind of struggled with on the resistance side, or was always finding support on the support side, you know, bouncing off them. So just going to go over and just kind of show where I see those levels. So on Netflix, I see multiple bottoms in the afternoon, just where I'm circling here. I'm going to circle support in pink, and I'm going to circle resistance in orange. Looks like you had a clear top there. Then you pulled back and made another little mini top there. And then kind of a double top here. And then again this afternoon here. And then at the open, you were stalling out up there. Now, it's kind of hard to explain why I'm circling the areas I'm circling. I'm circling them because my eyes are just trained at this point that, hey, that's where the stock bounced off of, and you know, it struggled to get below. That's where the stock struggled to get above once it started going down. so I'm circling them out. I can't give you a scientific answer, but I think, you know, this is how I learned, is I just noted areas on the chart where I felt like there was support and resistance based on, you know, clusters or backing off of highs or coming off of lows. And then I started to test those levels or observe those levels then during the day and see, you know, what that price action was like. So for instance, if you look at my prep for today on Netflix, you'll see that the first resistance level I had highlighted, this is for today, going into today, not talking about for tomorrow, this was what I had on my desk, was 328. So over under 325 setup, first resistance 328, first support 323. So you take a look at Netflix. The first low of day was 323.60, so in those 323s. And then look at the high of day. High of day right here, right at that 328 resistance level. So, you know, whatever prep work I did yesterday, I guess I did a good job, because that's exactly where it stalled out. So I know that I've got it in the right place. So that's what I would do if I was you. You know, write down your supports and resistances. So then the next day, observe them, and if you see it like me today, you saw Netflix respect that 328, then that tells me, all right, good job. You did you had your analysis, you had your support and resistance analysis in the right spot. All right, so just going to do Amazon support and resistance too. Again, just going to circle the levels where I see resistance. I think that's the best way to kind of give you some insight into how I feel you should identify it. Now, Amazon's interesting because you had what looked like pretty solid resistance around 292s on multiple occasions today, 4 times. But then, right into the close, you made a move above 292. So my next resistance level, or primary resistance level anyway, really isn't up until the opening price action, which was on 296s. That's the only major resistance that I expect. So, you know, I'll have an over-under 295 setup, and 296s will be my first resistance point. On the support side, looks like you held 290 in the afternoon, and then below 290 you had a low right there at 288 and a low right here at 286. Amazon's not a great example today, honestly, because it had a lot of channel action. Let's look at Tesla. Tesla had a lot of channel too. All right, Google's decent. Google had some up-down flow to it today. So you can see support, you held the 512-ish, 513s, and then you also held 511s. So you've got 2 key supports there from Google. And you could argue also that you had a support here at 516 because you made a bounce higher, went sideways a little bit, and then another bounce higher. So I would also include support right there. On the resistance side, you know, you've got resistance here, but I'm probably going with an over-under 520 setup. So I am, you know, picking resistance above 520. And again, similar to Amazon, the only major resistance I see on the day above 520 was the opening price action, you know, around the 522, 524 area. So I like using a 3-minute chart to plot my reference point resistances. And then, again, another webinar that we have here that I want to link you to that just kind of explained my over-under setups. And I just mentioned Google over-under 520. Unfortunately, this video is not time-stamped, but it's the second question asked, so it's probably around the 20-minute mark or so, because I think the first answer was a long answer. But so watch that video too, because when I explain the over-under setups and the terminology and why I go with that type of technique, it'll also make your timing easier, because you'll understand why I'm entering Apple at 595, why I'm trying to short Google if it loses 530, and Amazon if it loses 300, stuff like that. All right, so now let's look at the examples you submitted to me of your own charts and kind of piece through some of your trades here that you sent in. So first of all, looking at this first chart that you sent me, you have way too many trend lines. It's just kind of random. But again, this isn't necessarily your fault. I mean, this is Facebook. This is a stock where every 60 cents is a 1% move. Every 30 cents is a 0.5% move. So there's a lot of percentage move happening without a lot of dollar movement happening. So that's going to lead to, more, or the temptation to put more trend lines. But with that said, you still have too many here. What I would say, and I'm just going to use a blue marker for this, I'm not going to highlight specific support or resistance, I'm just going to highlight the points of reference that I see, and also I'm going to just look at today, because it's too busy if I look at 3 minutes. All right. So first of all, the blue's not good. All right, that's better. So there's your first key resistance. You come up and you come off of that high right away real hard, okay? So that's number one, sticks out like a sore thumb. Then you have this big down move here, and you don't start bouncing until right here. So that becomes my key support, and you have a trend line there, so that's good. Good job. I agree with that one. Then you bounce up here, and you come back down here. Now you put another trend line there. Personally, I wouldn't be putting another trend line there. It's just, this is the key support that you bounced off of, so that's the key support level. Yeah, this is a higher low that you maybe want to take a note on and be aware of, but I wouldn't clutter my chart with it. And then you have this level here. So to me, this is my channel. Here's the top end, and here is the bottom end of the channel. It is just that simple. All right, so that's the first chart you sent me. And now what I like is that on your second chart, you pretty much drew exactly, what I said. For the most part, you've got your channel a little bit higher and a little bit lower, and that's fine. You're being subjective with that analysis, and I'm not going to tell you that you're wrong putting your trend line here instead of down here, and same thing with your top channel line here instead of up here. You actually, had more price action where your trend lines are than you had where I said I would have put mine. So, I definitely understand why you put them there. And that tells me that, you're already getting the hang of it and know the adjustment you need to make. So that's good. I would just keep trying to have your charts looking like the second example you showed me and not the first example. The second example is great. I would not nitpick this at all. So now let's look at some of your trades that were placed. So I need to know, though, because I need to know, are these times Eastern, or are the times lined up exactly with the times in the email you sent? Okay, so you said you bought at 9:33. So that means you bought like right here, right? Not earlier. Like you bought when it says 9:30 on the chart. Okay, you gave me the Eastern time in the email. So that means the times you gave me are Eastern, but the times in the chart are Pacific, right? Okay. So you gave me a 9:33 estimate in the email, so I need to look at a 6:33 on the chart, if I'm understanding you correctly. All right, got it. All right, so 6:33, you bought a call, and let's zoom in here. I'm going to do the best I can to analyze this. Thanks for sending in the examples. Makes it a lot easier. Although, to be honest, let me just pull up a chart on my Facebook. That way I'm not trying to zoom in and all that stuff here. So let me shift to my other screen. And let's pull up Facebook, since my times are Eastern anyway. That way I won't get confused, if you don't mind. But on your channels, you're doing a good job. You're doing a great job. All right, so you bought at 9:33 after seeing this first candle. I understand why you'd buy after a first candle like that. It looks pretty good, right? But the one thing I do want to point out is you're dealing with 59. So I don't like the round levels to begin with on a stock like Facebook, as I've already discussed. But if you're trading it, every 1 point is probably considered a round level. So I think you maybe jumped the gun a little bit, because you got some price action above 59, but you know, it's one of those 1 point levels where you want to see, can it, put in some time above 59 and stay steady. And, it wasn't able to, so maybe jump the gun. But what I like is you said you exited your position at 9:35. That tells me you were not waiting around to see what the result of this candle right here was going to be. You had an ugly wick. Let me get this orange out of here. You had an ugly wick up here, and you just got out. And I love that. That's great. And that's something that traders, when they're starting out, have a really hard time doing. So great job. Maybe you didn't have the best entry, but you didn't wait around to see what was going to happen, what the consequence would be. You got out. So your next trade was buying puts at 9:46, which is this price action going on right here. All right, so a little late to the put entry, but you came below the around 58 mark, that dollar mark. You had clearly seen a good move to the downside off the bat. So I like where your head's at by buying puts, because you're playing the trend at that point. And then you sold at 9:49, and I just don't know why you sold. There wasn't a reason to sell. you came below 58 and it looked like you were staying below 58, so at that point, you know, your psychology needs to be that, hey, it's staying below 58, so this thing's trading lower as long as it's staying below that dollar mark, and you know, you just sold too soon. But again, your idea was right, and that's great. That should be very encouraging for you, the fact that you had the trade, you just sold too early. And also what I'll say is maybe you were a little jittery because maybe you didn't get the best entry. Looks like you bought in after a pretty decent leg lower, which is good because, you know, the trend is easy to identify at that point. What I would say is, you know, encourage yourself. You believe that you have talent. I would imagine that once you saw this candle here, once you saw the break to a new low a day, I bet that you thought Facebook was definitely going lower. And I'm sure that's what you thought. But yet, for whatever reason, you waited until it had already dropped another 1% before you decided to take an entry, even though I know you were probably already thinking about it. So you just kind of hesitated. But again, completely natural thing to do as a new trader. The important thing is that you were on the right side. You just kind of sold a little too early. And you know, what I'll say is it's much harder to correct your entries than it is your exits. But you're already thinking along the right line of the trade, so that's good. I would ask you, you know, did you have something written down? When Facebook is putting in this price action right here around this 58 mark, were you taking notes in real time saying, all right, as long as it stays below 58, you know, I'm going to stay short. All right, mark the last price. It's at 57. Okay, now it's at 57.80. I'll post a screenshot tonight of my notes that I take. I'll post it to my Twitter, so check that out. And you know, you can see mental notes are no good. Mental notes are there's no such thing. They don't help you. At least not yet. Not with our experience. Mental notes help once we've been doing this for 10 years. All right, so, but again, like I said, you had the right idea behind the trade. You were right about the direction. Just a little shaky in terms of, you know, how you exited. All right, so then your final trade was at 9:59, so it was during this candle right here, and you exited at 10:03. And this is a classic example of, you know, a trade that should have never been made because it should have been the end to the first trade you made. So this candle right here, this is the move you knew was coming, and this is the move that you are ringing the cash register on from the short trade that you bought right here, okay, when it was around 58. Number one is your original entry on the trade we just went over. Number two needs to be your exit, okay? That's where you're cashing out like Travis Porter. The problem is you exited, you know, too early, and you got excited when you saw this because you thought, oh, fuck, I'm right. I knew it was going to do this. And so you chased it. And then, you know, it comes back up and you got shaken out because, you know, the reason it's bouncing so hard is because everybody who shorted this move right here, they are taking profits on this move right here and causing a bounce, all right? And you saw the exact same thing again when you came back down, made a new low, only stayed down there for a minute, and then started bouncing back up because the short trade is over. So the final trade is just, you know, you're entering the trade after it's already over, but in the future you're going to be good and you're going to take notes, and, you know, right here, this candle here where you entered the final trade is going to be where you are exiting the, you know, original short position that we just went over. And that's that. I don't think there's a whole lot wrong with your technique as far as your skill and your thought process. If you showed me trades that, hey, I bought calls when this move happened, then I'd be concerned, because then it would be a matter of, I don't really know what you're seeing that's telling you to buy calls. But you bought calls and then you switched to puts, and that's very impressive for a new trader. The hardest task or skill to develop is changing your mind on a dime, and you switch from calls to puts pretty quickly, so that's good. That shows that you're open-minded. There's just some little things that you need to do better in order to have that trade become a winner.